Good afternoon, everyone, and thanks very much for joining us this afternoon. I'm John Orchard, OMFIF's CEO. Welcome to our discussion today on global public investors, which accompanies the launch of our 2020 survey into their asset allocations and intentions. Although the practical circumstances have been tough for obvious reasons, we've been very lucky with our timing in many ways. OMFIF's survey was in the market as COVID hit, so we have an insight into where GPIs may go next as they digest the economic and market information from the crisis, including the huge amounts of QE and the fiscal stimuli set against very difficult economic indicators. And we found a mixed and intriguing picture of the hunt for yield carrying on in plenty of places, while others move to a more risk-off approach. We've surveyed and analysed about half of the $40 trillion in AUM at GPIs, just slightly more than last year, and at a time when overall AUM have grown. My colleague Danai Kyriakopoulou will take you through the key findings shortly. She and her team have done a fantastic job, so thanks to you, Danai. Mark Burgess, who is chairman of the investment committee and board member at Hester in Australia, and also on the OMFIF board, will chair a discussion on the results. And we've got some great presentations from well-placed industry commentators today. In a moment, we'll hear from Natalie Black, Her Majesty's Trade Commissioner for Asia Pacific at the UK Department for International Trade, busy striking new trade deals for Britain at the moment, as many of you will know. She's going to talk about the opportunities and benefits in the move to ESG investing that we'll also be detailing a bit later on with Danai. But before that, I'd like to thank our sponsors for supporting this event and the publication, Amundi, Aviva, Bearings, BNY Mellon, Capital Group and DZ Bank. And I'd also like to thank KIC and QIC who helped contribute. Natalie, over to you.
Hello, John, and hello everyone who's joining us today. Firstly, can I start by saying a big thank you to you, John, for inviting me to join you today, and I'm very pleased to make a few opening remarks. I'd also like to take this opportunity to thank OMFIF for all the work that you do in the region. You are a key partner for the UK government, and over the last month in particular, you've been a great supporter of the Lord Mayor's virtual visit to Asia Pacific, which took in Australia, Singapore and Japan. And I just wanted to say a big thank you for the events that you put on around that, including an excellent event in Australia last week with Mark Burgess. And to all your members, I really just wanted to pass on my thoughts for you, for your family, for your colleagues at this difficult time. We know, of course, for want of a better phrase, it's unprecedented, but my thoughts are with all of you as we tackle this together. So today's event and the launch of OMFIF's Global Public Investor Report is important because it demonstrates the significance of Asia Pacific in particular. It is this region of the world that has the greatest concentration of GPI assets, with institutions holding nearly 40% of total GPI assets around the world, as the report shows. But exactly as John says, it's also extremely timely. As we know, and as I've said, we live in unprecedented times. And as attention shifts from responding to the health crisis to dealing with the economic fallout, the role of public investors will be more important than ever. The world as we knew it has changed, and the shock to the global economy from COVID-19 is likely to be at least twice as large as the global financial crisis. And governments around the world are taking unprecedented steps to protect and stimulate their economies. And of course, this will have significant consequences for debt and in turn, inequality. We will have to reassess the nature of the global economic landscape to kickstart growth, and one of the surest ways to do that will be through global trade and investment. But this will have its own challenges, and unusually high uncertainty has weighed substantially on businesses' willingness to invest. And we are already seeing substantial capital outflows from emerging markets. And of course, recently, UNCTAD forecast a sustained global FDI fall of around 40% until at least 2021. And in addition, we are seeing a fundamental shift in the expectations of governments. And trends that we were probably all discussing a year ago have ramped up significantly, from supply chain diversification to adoption of technology across a whole range of horizontals. So although this brings substantial challenges, it also highlights significant opportunities, particularly for long-term capital. And this is particularly true in the context of responding to the climate crisis. The call for clean growth, green energy, green transport, and green finance is likely to accelerate as countries begin to look towards the medium to long-term economic recovery. And populations expect more from their governments and businesses, and demands for action to confront environmental degradation will become even louder ahead of COP26, the UN Climate Change Conference, which the UK government will host in Glasgow next year. Our Prime Minister in the UK has committed to build back better and build back greener, and we will deliver this by making the most of our institutional stability, our entrepreneurial skills, our innovative R&D environment, and our flexible skills base. And this will ensure we continue to be a great place for funds like those represented today to continue to invest, but also lead the charge on ESG. I hope that you have noticed and picked up some pretty significant announcements recently, including the roadmap to increase public R&D investment to £22 billion per year by 2024, and significant commitments to building roads, schools, and hospitals, with alongside recognising that we need to continue to be the best place in the world for top talent, and we will be opening a new office for talent right in number 10. So I hope that gives you a hint of where we see the economy around the world going. And I hope together we can see the opportunities around ESG in particular. But as we all know, this is not going to be easy. And that's why forums like this are so valuable in terms of comparing what we are all seeing together. So thank you very much, John, again, for the opportunity to join you today.
Natalie, thank you very much indeed, and setting the scene very well for something we're going to discuss in detail later on. Just a procedural point: if you're not speaking, please could you put your microphone on mute? Thank you very much. Thank you again, Natalie. I'd like to hand over now to Frank Scheidig. Frank, are you with us? Frank Scheidig's Global Head of Senior Executive Banking at DZ Bank. Frank. Frank is having technical problems still, so we'll pass on. Perhaps we'll come back to Frank a little later. Frank was going to introduce Senator Jane Hume, Assistant Minister for Superannuation, Financial Services and Financial Technology at the Treasury in the Australian government. So, Senator Hume, perhaps we could pass straight to you.
Thank you very, hello, can you hear me? Thank you very much for that introduction, John, and I'm sorry that Frank couldn't be with us. It really is an honour, though, to be able to speak
I'm with you guys.
Hi, Frank, that must be you.
Hello,
it's an honour.
good afternoon, Jane.
Morning, Frank. We'll introduce you again in just a sec. We'll come back to you in just a moment. We've now got Senator Hume talking.
Okay,
we'll pass
to
you in a moment. Thank you, Frank.
I just don't know how long I can able to talk because I'm in a train, and that's my problem. Sorry for that.
Never mind. Over to you, Senator Hume. Thank you.
Thank you very much, John. And Frank, I'm dying to know where that train is going to and from. What an extraordinary metaphor you've given us there. Look, it's an honour to speak to all of you today and this incredible audience of respected professionals from around the globe. It is really hard to believe that in Australia, it's only 6 months ago this week, on the 25th of January, that we recorded our first coronavirus case. To its great credit, the Australian government acted very quickly and decisively to address the health risks. And despite the second wave that we are now experiencing in my hometown of Melbourne, we know that Australia has been very fortunate to have tackled the health crisis so effectively. On the economic front, the Australian government also acted quickly and decisively. In the last fortnight in March, we committed a record $289 billion of economic support to businesses, to households and individuals, equating to around 14.6% of GDP. Programs for businesses included cash flow boosts for employers, accelerated depreciation deductions, assistance for apprentices and trainees, and temporary relief for the financially distressed. Households and individuals have also been supported with 2 rounds of $750 payments to supported individuals, and the temporary expansion of the job seeker payments of around $550 a fortnight. On the 30th of March, we announced JobKeeper, a 6-month program of wage subsidies that has maintained links between employers and employees, supported cash flow and providing income, and building a bridge to the other side of the health crisis. Now, JobKeeper is the largest economic lifeline in Australian history. Just last week, we announced that we will be extending JobKeeper by an additional 6 months, with some modifications to recognise the asymmetric nature of the recovery. We've also allowed Australians impacted by the pandemic to access a limited amount of their own superannuation retirement savings. It has been a peacetime economic injection like no other, and we are not out of the woods yet. Historically, a great strength of the Australian economy has been the resilience of our financial system. This was certainly the case during the global financial crisis, and it's playing out once more during COVID-19. Some of the most significant actions in response to COVID-19 have involved the Australian government working closely with the financial sector to build a safety net for Australian consumers and businesses. Banks have restructured loans, over 900,000 loans in fact, and deferred mortgage payments, covering in excess of around $250 billion. The insurance sector has supported customers by ensuring pandemic cover and extending cover to those that may have been stood down. And our superannuation funds have worked very closely with government to efficiently respond to requests for government's early release of super scheme for those that are in financial distress. It's this support from the financial sector, combined with the government's economic and fiscal response, that has staved off the worst case scenario economic forecasts from those early days. And while we're not out of the woods, Australia is well placed to strongly emerge from this crisis. At the end of December, Australia's unemployment rate and welfare dependency were at 30-year lows, and our participation rate was at historic highs. We had and still have a AAA credit rating from the 3 major agencies, and we were looking forward to delivering our first budget surplus in 11 years. 6 months later, those numbers have changed dramatically, but we know that without the support measures supporting livelihoods and bolstering confidence, Australia's unemployment rate would have been 5 percentage points higher, equivalent to around 700,000 jobs. The green shoots of recovery are promising. Of the 1.3 million Australians who lost their job or were furloughed due to COVID, around 500,000 were back in work in June. And Treasury expects thousands more will be back in some form of work by the end of the year. Australia is the only developed country to have its growth forecast upgraded for 2020 by the IMF in its June World Economic Outlook. And this gives us confidence that we are better placed than most other nations to chart a path to recovery. Fundamentally, Australia is a trading nation. We believe that trade and investment supports job creation, productivity, technology sharing, and the exchange of ideas. The government has a strong track record of completing bilateral and multilateral free trade agreements. We now have 70% of our two-way trade with countries in which an FTA is in place, and that's up from 26% in 2013 when the coalition came to government. As we speak, Australia is in the process of negotiating a free trade agreement with one of our closest economic partners, the United Kingdom. This agreement will reinforce the already strong economic ties and provide new opportunities, including in services, in digital trade, in investment, and in ease of doing business. In Australia, 1 in 5 jobs is trade related, and companies that take advantage of direct foreign investment support 1 in 10 jobs in our economy. So we're acutely aware of the value of foreign investment. The government has recently announced changes to our foreign investment framework. Now, these changes mirror those of many of our key trading partners, and they ensure that our framework keeps pace with the emerging risks and global developments, both geopolitical and pandemic related, and apply the right checks and balances to ensure that investments are not contrary to Australia's national interest. I would stress that these are not changes that will stand in the way of long-term capital inflows. Australia has always and will continue to welcome a wide variety of trading partners. Perhaps surprisingly, while China is often in the spotlight as Australia's largest trading partner, it ranks only 9th as a source of foreign investment, with just 2% of the total. The United States remains our largest source of investment by far, with nearly $1 trillion invested in Australia, followed by the UK, Belgium and Japan. I passionately believe that investment in our vibrant financial services sector is essential to Australia's prosperity. A hallmark of our trade negotiations, including those with the UK FTA and the Digital Economy Agreement that we're currently concluding with Singapore, is an ambitious approach to trade in financial services, including measures to boost collaboration between regulators, fintechs and data holders. In the fintech space alone, despite the COVID doom and gloom, it's been encouraging to see some terrific success stories for high growth Australian companies drawing on international capital like Airwallex, Afterpay and Zinja. The message is clear: Australia is open for business, and that's especially true in the high growth tech and fintech space, where demand for Australian innovation will always endure. On the topic of financial services, one of the unique characteristics of our financial system here is our superannuation pool, spurred on by the past 28 years of compulsory employer contributions. The Australian super system is worth $2.7 trillion, or around 1.5 times Australia's GDP. It's the 4th largest pool of pension assets in the world. As part of our COVID response, we have allowed those in the greatest financial need to unlock up to $20,000 of their own retirement savings. Now, while there is clearly a trade-off in this decision, this program has proven life-changing for many who might otherwise have risked their credit rating or sold an asset or approached a payday lender, the impacts of which could have been felt well into their retirement. The Australian super system is very large and stable, and the early release scheme has had no significant impact. Indeed, the anticipated total withdrawals amount to around 1% of the total pool, or around 2 days trading on the ASX, and not even 1/3 of the compulsory super contributions made by Australians to their funds just last year. Superannuation will continue to provide a growing source of long-term investment capital, both domestically and overseas, as it searches for returns at scale. As the IMF has recognised, Australia is among the best placed of any country in the world to emerge strongly from the COVID pandemic. Our stable financial system has worked hand in hand with government policy, including our largest fiscal boost on record. But Australia's prosperity and growth will depend, as it always has, on our strong trading relationships and capital investment inflows. We are constantly exploring opportunities to enhance relationships between firms, regulators and policymakers internationally, and to address any frictions that may inhibit cross-border trade and investment. And as we look to the recovery period, I really look forward to seeing those relationships flourish. Thank you again for the opportunity to share Australia's experience with you today, and I wish you luck for the rest of the webinar.
Thank you very much indeed, Minister Hume. That's very kind of you to come and talk to us today. Very interesting and relevant. Frank, are you still with us? Bist du noch dabei?
Yes, I am, but I understand there might be questions to Jane before.
Okay,
John?
well, yeah, Frank, let me just introduce you. You're Global Head of Senior Executive Banking at DZ Bank. Perhaps you could say a few words, and Angelia will set up any questions that we have for Minister Hume while you're talking.
Sure. Jane, again, very sorry. I was on mute for whatever reason, but I hope you enjoyed it talking and starting a little earlier then. Yes, I'm pretty sure the audience, the people wherever they are in this world, were eager to listen to you and to your nice story about Australia. And I don't know if that had been said. You are also a former colleague of the banking industry. Yes, so very experienced. Again, warm welcome to you. Yeah, I just will spend 2-3 minutes on the current situation we face here in the European time zone. But first of all, thanks very much and congratulations to OMFIF, John, David, and the whole team for this excellent GPI release, which we have on for many, many years now. I can't say decades. That is coming along the future, along the line. Anyway, having said that, if you hear background noises, I'm sitting in a train towards to Munich from Frankfurt. That is a new way of travel, safe, hopefully. But let me come to Europe. GPI investors mainly, obviously, were focusing in the past years, investing into one major currency, that is the US dollar, and on the other hand, very strongly in FI and fixed income bonds. Those are often being issued by sovereign supras, agencies, and so on and so forth. In Europe, COVID-19 related, and given the recovery plan and also the green plan, Europe will have a new supra sovereign issuer, which is the EU themselves. They start first with a SURE program, which is 100 billion euro large, and it will be followed next year to finance a 750 billion program over the next coming years. That makes the EU the largest multi-sovereign issuer in our hemisphere. And I want to draw your attention on the following. I personally predict that it's an early stage and we will see the EU coming along the line with huge volume over the next decades. And it's a big change of Europe. Whether the Germans and other members will like to hear that or not, I think politically the willingness is there to let a new European debt office follow the routes. That is my personal prediction, which will come. But what is the point? I think for Europe it is a good thing, because overall we will have cheaper funding in Europe, and we will give the world of investors, particularly the GPI investors, for the first time in history, a serious alternative. First of all, in the currency side, and I think particular Asia Pacific will appreciate that, because it is an alternative through the US Treasury market and through the dollar as a currency. Secondly, obviously this issuance program will provide a whole curve, most likely more flexible than what we have seen so far from issuance of the US Treasury activities. Yes. And here the huge Asian Pacific accounts and investors, whether these are pension funds, state funds, other sovereign investors, have to and will appreciate that. It is also a big game changer. It makes our political scenery, which is a little bit in rough sea at these current days, also way more stable. And I think also which could come with it is when Asia is pricing derivatives, they trade on 2-day-old reference rates from the US swap market. If the euro will become seriously the alternative through the US dollar, and it will be treated like that, the next step, or probably even parallel to that, I predict that Europe will release its own swap rates in an early morning time, 8 or earlier, so that Asia can use these reference rates and trade not anymore on the US ones, and this will be just 1 day old. So you see, going forward, here are a lot of chances, and I don't know if the world investors and the world has already recognized what chances are here with these European new giant that is, I could talk for many more minutes about that, but I just want to encourage you and hopefully get appetite. And I'm very happy to discuss that further over the next days and weeks. And Jane, I think also Australia, New Zealand, so the Pacific Rim will have tighter genes with Europe, despite the fact of 9 to 12 hours time differential.
I certainly hope so. Thank you, Frank.
Thank you very much, Frank. And you raise an interesting topic. Denai will talk later about the currency side of investing. The dollar reigns supreme. What you've just said, you heard it here first, may slightly alter the balance in favour of the euro, which people were not long ago writing off for all the reasons we understand. So, Frank, thank you very much, and look forward to talking to you a little later at the European launch too. Does anyone have a quick question for Minister Hume before we pass on to Denai to reveal our results? If you do, could pop it in the chat function or turn on your mic and camera. Okay, all right. Well, thank you very much, Frank and Jane. We very much appreciate you joining us today. I'm going to hand over now to Denai Kirakopoulou, who is our chief economist, who's going to take you through our findings. So thank you very much, Jane, and see you later.
Bye-bye. Cheers.
Bye-bye. Thank you.
All the best.
Denai, over to you.
Thank you, John. A warm welcome from me as well. Good afternoon, everyone. In Singapore, it's a pleasure to be here and present the findings of this year's Global Public Investor Report. So this is the 7th year that we've been publishing this report. But first, who are global public investors? This is a term that OMFIF has been using for 7 years to define institutions that manage public money. So our analysis looks at 750 such institutions. This includes 174 central banks, 489 public pension funds, and 87 sovereign funds. They are spread around the world, as you can see in this slide. As we heard from Natalie, the most assets are concentrated in the Asia-Pacific region. That's over 38% of assets are there. We have some of the biggest GPIs in Asia-Pacific, such as the People's Bank of China. At number 1, we have Japan's Government Pension Investment Fund. We have China's Sovereign Fund, the CIC. We have the Bank of Japan. These are all top GPIs in terms of the level of their assets. Also, in the top 30 or so, we have Singaporean funds like GIC, Temasek as well. But in terms of the number of institutions, there are actually not that many in Asia Pacific, just over 110. Around 2/3 of the institutions are located in Europe and North America, which collectively also hold around half of the assets. In Asia Pacific, sovereign funds hold quite a lot of assets. You can see that we have 26 sovereign funds, but in the Middle East, we have the same level of assets. So that's 2.9 trillion, but for half the number of sovereign funds. So even though we have more sovereign funds in Asia Pacific, the Middle Eastern ones are quite big as well for oil exporting nations in particular. And then we also look at institutions in Latin America, Middle East, and Africa, but these are less significant in terms of size. Now, as I said, we've been tracking this for 7 years, and this is now the 3rd year in a row that we're seeing all institution types increase their assets. It was 2016 that we saw a difference in that, where central bank assets dipped slightly. This year, institutions raised their assets by a joint 1.9 trillion to 39.5 trillion. This is equivalent to over 43% of the global economy. So they're a powerful force in global financial markets, and they increased their assets by just under 2 trillion. Most of that 1 trillion was added by pension funds. Pension funds in Asia Pacific grew particularly strongly by 9%. So this was outperforming the overall growth of GPIs, which was around 5%, and it was an acceleration from last year. Central banks and sovereign funds grew more modestly, but it's important that all 3 institution types grew their assets. And it's important also to note that what we measure here are assets up to the end of 2019. So that's before the COVID crisis hit, but what it shows is that it's very important that institutions joined entered 2020 with high number of assets, so they were well prepared to weather the COVID crisis. We will talk a bit later on about what they've been doing during the pandemic and the economic shock from it, because as John mentioned, the survey was conducted during the pandemic shock. The general figures mask some regional differences, however. So in this slide, you can see how different regions performed. And you can see that the biggest increase was in Europe. So European fund assets grew by 8.5%, so outpacing the 5% that was the general growth in the different regions. Asia Pacific and North America also saw strong growth. Latin America, Caribbean was the region that saw the weakest performance, so assets actually fell. That was both in the case of sovereign funds and central banks. And in Middle East and Africa, we also saw some modest increases. But in Europe, this was mostly driven by central banks, and in Asia by pension funds. When we look at the particular funds that saw a big increase, the top 5 funds were responsible for about a third of the increase, of the total increase in assets. I'm trying to move this slide. So almost a third of the total increase in assets was driven by 5 funds. So that's the Government Pension Investment Fund in Japan. It moved a lot into domestic and foreign equities last year, and that helped it see an increase in its assets. I'll go a little bit into the drivers. Norges Bank Investment Management in Norway, the Norwegian sovereign fund, it had the most successful year in its history in terms of returns. The Central Bank of the Russian Federation, Dutch pension fund ABP, and the Military Retirement Fund in the US. These were responsible for around a third of the total increase. And then the top 10 funds were responsible for around half of the total increase. You can see here also the biggest climbers and the biggest fallers in terms of GPI. So in the highest climbers, you can see 2 Russian institutions. I already mentioned the central bank, the sovereign fund as well, more than doubled its assets. And then you can see in the falls that we have some central banks from Latin America, as well as some Chinese funds and the US. And I also should have mentioned in the previous slide that China, even though the central bank increased its assets, other funds saw their assets decline. And that's the first time that we're seeing that also in China, some more consistent declines in GPI's reserves. So what drove this performance? A lot of GPIs have recently been moving more forcefully into equities, and that helped the stock market good performance. We had 28% increase in the S&P 500 over 2019. That helped boost the values of their assets. And at the same time, the gold price also was something that contributed to the rising value of GPI assets. The US bull market also widened global imbalances. That's something that we track every year in the GPI report as well, looking at the net international investment position. So that's the difference between foreign assets and foreign liabilities of different countries. And this meant that as the US holders of US treasuries and US assets saw their foreign assets increase, so we had creditor countries like China, like Germany, increase their net international investment positions. At the same time, we had some fiscal expansion in the US and in France that meant these debtor countries also saw their deficits increase. So we saw a further widening of net international investment positions. And there is a report, a chapter in the GPI report itself written by my colleague Chris Papadopoulos, who has looked into this in great detail in terms of the changes in creditor and debtor nations globally, which I recommend to you all. Then this year we also did an asset allocation analysis. This covers 19.5 trillion of assets, so around half of GPI assets. Is quite comprehensive, covers 92 institutions. And we look at how are the portfolios composed, and that helps us understand why are assets growing or falling in different institutions. There can be some idiosyncratic characteristics, but there can also be some general trends. And the equity market boom helped GPIs more this year than in previous years because we've seen that they have been moving more of their assets into equities. So now over 22% of GPI assets are in equities. This includes 8% of central bank reserves. If you think of central banks as fairly conservative investors, that's something that is really a big difference from a few years ago. They've also been diversifying into corporate bonds. So overall, 10% of GPI assets are in corporate bonds. That is 11% for central banks. Still quite conservative investors, 66% are in government bonds. Sovereign funds are more adventurous. You can see over half of their assets are in equities, and quite a big allocation also to real assets, which includes real estate, infrastructure, and private equity. Pension funds a bit more balanced, so under a half of their assets in government bonds, but also quite a significant allocation to equities, to corporate bonds, and alternatives. Central banks also having around a 6% allocation to gold, which again, we saw the gold price increase, and I think that's something we'll be exploring in the panel discussion as well. What has been driving this move into equity? So in the survey, which we conducted this year during the COVID pandemic, as John was saying, this is the most comprehensive survey that we've done, in the sense that 78 institutions responded to it this year. So it covers quite a lot of the GPI community. And we asked them what has been the response to the low yields to traditional reserves assets. Central banks as policymakers have been pursuing accommodative monetary policies and conventional monetary policies that have suppressed yields on traditional assets such as government bonds, and that has shifted their colleagues in the reserves management departments to move into riskier assets. So we can see here that just over a quarter of central banks said that they have responded to this by increasing their risk budgets. This is even higher for sovereign funds. Over a third, for pension funds, over a third of pension funds said that they increased their risk budget. Fewer sovereign funds because they already had quite high risk budgets that enabled them to invest in equities. So there's less of a marginal benefit there for them, as you saw also in the previous slide. The survey is also forward-looking, so we asked sovereign funds, pension funds, and central banks, how do they see their allocation in the future? And this was asked between April and June this year, so a lot of them were still grappling with the uncertainty from COVID-19. I think it was at that stage not entirely clear how financial markets will perform this year. So far, we've not seen the economic crisis translate into a financial one as well. Central bank and other policies have helped contain the contagion into the financial markets, but still quite a lot of GPIs were concerned about this, about a possible correction in the equity market. So we're seeing for the first time since we've done this survey, a net increase in the responses in terms of the allocation to government bonds. So still some plan to reduce their allocation to government bonds, but even more plan to increase it. The same for cash, even though more plan to reduce than to increase. It's the first time that we're seeing some planning to increase it. For gold, also more increases than decreases. That's not to say that they don't plan to continue investing in more risky assets. So equities, you still see quite strong planned growth there. Infrastructure, real estate, particularly for sovereign funds. So just under 70% of sovereign funds plan to increase their investments in infrastructure. That's a massive number. If you look at the numbers here, these are for GPIs in general, but for sovereign funds, it's quite high. And for pension funds and sovereign funds, they both, over a third of them plan to increase their allocation to real estate. So the move to alternatives and to find return where there has not been in traditional assets continues. Another theme that we explored in the publication was the currency allocations of GPIs. So that's something that Frank mentioned before as well, the move to the euro. We see that here, that there is appetite for investing in euro, still continued growth for the dollar, but also some planning to reduce it, and the renminbi as well emerging as a currency that more investors are looking to increase their allocations to. But in terms of the current picture, the dollar still remains the dominant currency in the monetary system. And this year, we also wanted to explore a little bit other contendants to the dollar, not just other currencies, but whether perhaps a synthetic hegemonic currency, this is what Mark Carney called a sovereign digital currency basket, or a digital SDR, in a speech that he made while he was governor of the Bank of England. We wanted to explore whether something like this could be of interest to GPIs, and my colleagues Bhavin Patel, who heads our fintech activities, and Pierre Orlib, wrote about in this year's GPI. There is a chapter about this digital SDR, which I highly recommend, on how digital currencies could develop. It's still very, very early stages. As you can see here, the vast majority of GPIs are not even considering or open to using such a basket, but still just a tenth of pension funds and central banks are considering it, which we thought was interesting, and we plan to continue looking into this topic as part of our Digital Monetary Institute, which we launched a few months ago, and some of you are members of. And then in terms of big themes of the survey and of the GPI publication in general, one big theme was the weighting between safety and risk. I touched on this a little bit already. Return to safety, but at the same time wanting to have returns. So there is a chapter in the GPI looking at investments in the technology sector in particular. Quite a few GPIs looking to make more investments there because of their large scale, high returns as the primary motivation, but also some of these technology firms have very good ESG scores, for example, because they don't belong to sectors such as heavy manufacturing, etc., which means that they tend to score highly or be included in these indices, and have also been performing quite well, preparing for disruption risks, also having a more developmental mandate in supporting domestic innovation. That's also very important to Singapore, as we all know. So that's something that, again, my colleagues Brandon Chai and Davin Patel and Pierre Orlib have been writing in the GPI as well, and there is a chapter on that. Weighting safety and risk, another thing that GPIs have been doing has been setting up representative offices elsewhere in the world to be able to access local markets more directly. So we see here what are the top centers for GPI representative offices: New York, London, as we know very well at OMFIF. Quite a lot of you are part of our community, representatives of central banks, and you see quite a lot of Asian centers as well: Beijing, Singapore, Hong Kong, Shanghai, and Tokyo. And then we also have San Francisco, that is also part of the drive for GPIs to access more technology investment. And it's interesting also to see which GPIs are most represented globally. So the Deutsche Bundesbank is actually the GPI with the most representation globally, with around 15 offices around the world. So that's also a report in a chapter in the GPI by my colleagues Katu Sita and Brandon Chai that I recommend as well. And then the second and final big theme that we had in this year's GPI was the rediscovering or reinventing of public ethos, and a big part of that is their focus on sustainability. We heard about this from Natalie, so we wanted to ask some specific questions, and we did this jointly with Bank of New York Mellon in terms of looking at how GPIs are integrating ESG. Is it through shareholder engagement? Is it through active investments in sustainable assets? Is it through divesting entirely from unsustainable sectors, or as some institutions, the Riksbank did this year, or rather last year, for example? And we also asked them what are the most material risks for their investment horizons in the next 10 years. And we have systemic environmental risks as a top priority there, but also social risk, governance risk rising in importance as a result of the COVID-19 crisis. And we have Didier Borowski on the panel later on as well. And Amundi have done a lot in this area too, together with IFC. Bank of New York Mellon, of course, as well. We wrote the report together in terms of their ESG activities. So it's something that asset managers are also taking on very seriously and working with GPIs closely to advance the ESG agenda. The Network for Greening the Financial System that central banks have set up, and of which OMFIF is an observer member, has also helped advance this agenda in the supervision side. But in reserves management, a lot of the GPIs, particularly central banks, are still quite conservative because of principles of market neutrality and so on, to invest in more sustainable assets directly. A second area where we've explored how GPIs rediscover their public ethos is through their communications. So last year, for those of you who were with us at the launch, you may remember we looked at central banks' activities on Twitter. This year, we looked at their public engagement through art. This year, we looked at which central banks have an art collection, when they started it, what have been their the origins of their collections, and also what have been the investment returns and how they see that as an investment. And then finally, the other area of GPIs rediscovering their public ethos has been how they've been supporting their governments in the pandemic. So here we all know about what central banks have done. They've supported them with pandemic emergency purchase programs. They've supported them with lower rates or specific liquidity facilities. But we also have a chapter in the report looking specifically at sovereign funds that my colleague Pierre Ortlib and I wrote, which looks at how sovereign funds have supported governments in the pandemic. So one thing they've done is drawing directly on the reserves to give to governments to spend, to conduct fiscal spending. Another has been to directly support struggling industries like airlines. We saw that in Singapore, in Malaysia, and elsewhere. Another way has been to issue bonds to fight the pandemic, such as in Italy and France, or to donate or invest in healthcare. For example, we saw the Russian sovereign fund help co-finance a vaccine. So this is just a flavor of what the GPI has been about this year. There's a lot of chapters in there. It's 190 pages that the hardworking research team at UNFIF has put together. And we're also grateful to our contributors who have helped put some light into this. Some of them will be on the panel later, like Didier Borowski, Agnes Bellesh, and others who have written about sustainable infrastructure, about the role of central banks, as well as GPIs themselves, the deputy governors of the Central Bank of Ireland, of Spain, sovereign funds such as Italy, CDP, BPI France, and others have contributed to the publication. So thank you to all of you who've put your input in this. I'll stop here and I'll hand over to one of our partners who has a video message for us for this launch. Thank you very much.
Thank you very much, Danai. Thank you to you and your team for the extraordinary amount of work you've put into this. I do recommend you all go to our website and download it. There's a treasure trove of information, data, thinking about what's going on in the world of investing, public investing at a very turbulent and interesting time. I'd like to hand over now to Mark Burgess, who I introduced earlier, to open up our panel discussion. Over to you, Mark.
I think we might be just about to have a video first. Is that right, John?
Look, I have 4 points I'd like to make today. Firstly, on the macro environment and the impact for markets. If I were to summarize the evolution of the macro backdrop in 4 stages, it would be shock, asset prices plummeting, which we saw in February, March. Hope, the market rally that we saw with equities and corporate bond spreads since the lows in late March. Then reality, where markets take a step back and assess the longer term impacts of shutting the global economy on balance sheets, unemployment, supply chains, and the consumer behavior. This is where I believe we are now. And finally, recovery, which takes time. Next, the US Federal Reserve's actions have been key during this crisis. The Fed cut rates, undertook QE, but they also committed to investing in a very broad range of credit sectors, including corporate bonds, both investment grade and fallen angels, and ETFs across the credit spectrum. The aggregation of these actions by the Fed during the darkest days of the COVID crisis has been the single most important driver for markets since March. Now, I'd like to address how we've been managing our credit portfolios this year. Our fixed income portfolios went into 2020 with a cautious credit stance, based primarily at the time on tight valuation levels. Now, clearly we didn't forecast a global pandemic, but there were signs of excess in the fixed income markets. For example, BBB rated corporate debt was at a record proportion of the investment grade universe. And we've seen progressively weaker bank loan covenants being accepted by investors. During this period of dramatically wider credit spreads that we saw in March, we used the opportunity to invest decisively in credit markets, particularly via the new issue market. At this juncture, however, we're beginning to get more circumspect as the rally appears to be outstripping fundamentals. And finally, I'll leave you with 3 actionable ideas. Firstly, you can do better than cash. Specifically, consider holding shorter duration investment grade securities in lieu of cash. Secondly, stay strong at the core. Within your sovereign, SSA and high grade corporate exposures, now is not the time for style drift. Core will likely remain key during the reality phase I spoke about. And finally, rethink income. Don't rely on one sector alone for income. A multi-sector income approach may provide a better path. Thank you.
Thanks very much for joining us. I might ask all the panelists just to put their cameras on if we can. I'll introduce myself first. I'm chairman for Asia for OMFIF, and previously was CEO of the Sovereign Wealth Fund here in Australia, and still actively involved in the asset owner community. I think today we meet at a very interesting time. It goes without saying, but it's particularly interesting for us at OMFIF because we're seeing a very, very clear intersection between the role of policy and its impact on markets. In some ways, I think we're fortunate that we had a GFC a decade ago in the sense that central banks knew what to do quickly for the pandemic. But we also saw central banks back at Jackson Hole last year, in my view at least, flagging of the need for fiscal, and that was pre-pandemic, but it has meant that they've come in with very significant fiscal involvement. But of course, this channels through the effect on investment markets and the effect for asset owners. And the one thing that we do at OMFIF, which is perhaps a bit different, is we not only have a large number of policy meetings and discussions, but we bring that together with asset owners in particular. And today we plan to do that on this panel. Just before doing that, I would like to thank each of our sort of contributors so far. John, of course, Natalie, to Danae and James for his video, but also I'd like to thank Senator Hume from Australia, where, as you're well aware, Australia has a very large superannuation or plan, and we'll hear from one of the large managers in just a moment. I now have the pleasure to introduce our panel. We have an excellent panel of 4 asset owners and a fund manager to give us a different perspective from Europe, and then we'll follow up with questions. If you have questions, please get ready to ask those. We're very, very keen for interaction at OMFIF, so we won't have a lot of time, but if you've got some questions, that would be terrific. So in terms of our panel today, Agnes Pellish, who is Chief European Strategist at Barings, with a lot of experience with the IMF, and we'll be speaking shortly. Our second speaker will be Sharil Rizwan from the Khazanah National Fund in Malaysia. Our third speaker will be Srikanya Yathap from the Government Pension Fund in Thailand. Our fourth speaker will be Dong Hyun Jang from the Public Officials Benefits Association in Korea. And our final speaker on the panel will be Leanne Taylor, the head of macroeconomic and markets research at CBUS, a large pension plan here in Australia. So we've got a really good mix of people with different perspectives, with different styles of portfolios. And so I think hopefully from this discussion, you'll get a sense of interaction with what's going on in the markets, how people are trying to position, and the way people are looking forwards. So I'll just ask all of the panelists if they could just stay on mute until I introduce you formally again. But I'd like to hand over to Agnes, who will start us off with a European and global perspective from Europe. Thanks very much, Agnes.
Hello, Mark. Thanks for the introduction, and very happy to be here. Thank you as well for the invitation. I think since I'm speaking first, I would like to summarize where we stand at this stage of the recovery from this unexpected global health crisis, and maybe this will facilitate the discussion before. So that's how I will use my 5 minutes of talk, and I'll make five points to describe the stage we're in. The first one, and maybe that's a perspective from the Western world more than from Asia, but we're going through a definite recovery, although it is a bearish one, and that's how it feels here. You know, much of the macro data confirm that the rebound has begun, but it faces persistent headwinds from a very fragile confidence related to the global uncertainty that we're in. And this results in very elevated savings rates, which of course is something that is common in Asia, but not so much in the US up to now. And these elevated savings are holding back activity. The second point is that, you know, prospects obviously depend on the dreaded second wave. Infection rates have risen in parts of the world, and this has meant new rounds of distancing restrictions. In Europe right now, for example, local partial lockdowns have returned in Germany, in France, in Spain, Portugal, in Belgium, and borders are closing on and off again. So the recovery in consumer confidence, which is so important for activity, depends heavily on virus containment, as we all know. The third point really that is so characteristic to this crisis is that the recovery stands on the shoulders of governments, and these are the shoulders of giants. The policy toolbox was ready from the past great financial crisis, and central banks basically just doubled the dose. They injected even more liquidity, they cut rates where there was space to do so, and they undertook asset purchase programs, even in a number of emerging markets, actually, where that was unprecedented. Central bank balance sheets have expanded tremendously, $8 trillion so far, and they remain at the margin the largest buyer of government bonds. On the fiscal side, governments knew that they were in the driving seat. This is a macro crisis that's playing at the micro level, and they knew that they had to. It was in their hands really to try to reach the individual households and the single small and medium enterprise. They have on their side also implemented very large stimulus programs, which are adding to their large debt stock already by so far about 10 percentage points of GDP, which is something I'm sure we'll come back to. All these measures have been exceptional and synchronized. But the good thing is, or maybe the bad thing is, I don't know, depending on the perspective, is that governments will have to do more. As you know, probably the European Union announced last week a 750 billion recovery plan, which adds to a very large program that had of a couple trillion euros that had already been announced in the previous month. The US in turn is discussing a fourth fiscal package. And I think this will probably not be the end of it. Of course, this has implications for markets. We ask government to reduce risk, and they have, but this has diluted the price discovery process and limited creative destruction. And that's also something we'll probably talk about for a long time. The fourth point I'd like to make in this big summary of the global stage that we're in is that beyond government support and in this global environment, asset markets are hesitant at the current stage to rally further. Risk assets have rallied from the March and April bottom, of course, but they remain in limbo right now. Investment flows seem to show, as Danae explained briefly, both a surge for yield and a run into risk assets, but as well a rally in safe assets and a desire to diversify among safe assets, which also explains the weakening in the US dollar right now, which is an interesting phenomenon and is quite complex to interpret, really. At this stage, though, there are about three risks that we keep on the horizon on our side. The first one is, of course, to watch all potential indicators of permanent scars from this crisis on the economy. It's possible that a large part of the labor force will have to be reallocated from sectors that need to downsize as we live with the virus to more resilient sectors, and this will require more government support. At the same time, all these companies that so far have been supported by governments might fail at some point, or maybe they have taken too much debt during the transition process where government support was very high and they won't be able to pay that back. So there is also a risk in the economic fabric of the societies we live in, which is the SME sector in the Western world, and this may change the way that the economy functions in the future. The second risk I'd like to mention here is, that it's undeniable that geopolitical tensions have flared again, and this is leading to another source of uncertainty about the future of economic relationships and trade. This is one word with many different economic and political systems, and how this will play out could be rocky. In addition, this happens in the middle of US elections, and a lot of things can happen in the process to that. And the third risk I'll finish with is that it's also, it will be important for markets not to feel too dependent on government support, and for governments to disengage in the future, in due time, of course. Governments will have to set up a number of incentives for markets, and so that they allow them to adjust while maintaining safeguards. And this is a very difficult trade-off to balance. There is otherwise a risk of resource misallocation from too much support. And I will stop here. Thank you.
Thank you very much, Agnes, for such a balanced view from Barings Investment Institute, and I'm sure we're going to get some questions from those comments. I'd now like to move to the asset owners, and particularly a view from Malaysia from Sharil. I'll hand over to you if I could, and it'd be very interesting to hear your view on the current markets and positioning.
Thanks a lot, Mark. I think from a asset owner point of view, and especially from a sovereign wealth fund, we always tend to take a very long-term view. I think going into 2020, I tend to agree, I think, with some of the views that have been expressed. We took a view basically that markets were already fairly frothy towards the end of 2019 into the first quarter of 2020. And we took the decision to lighten our load a bit, especially in riskier assets. Turned out because of COVID to be a great decision. We know, of course, nobody anticipated that. But I think just like a lot of other funds, we may have missed catching a lot of the bottoms. I think, at that point in time, that during that very sharp correction, it was very, very difficult, I think, for a lot of funds to just turn around quickly and say, now's the time to go back in. So we put some money back to work because we felt we were underweight on some markets, but quite clearly, like a lot of funds, I think, the scale of that recovery, driven by so much government liquidity and subsequently retail liquidity as well, has kind of passed by a bit. But the way we see it essentially, I think, is that we believe essentially that we are getting into an economy now whereby market valuations are obviously disconnected a bit from some of the economic realities that's on the ground. And really, as an investor, you're essentially caught in two minds, right? Do you go in believing basically that corporate performance and economic reality will catch up to valuations, or do you essentially sit by the sidelines, right, and wait for a better opportunity? It's a very difficult decision at this point in time, given where markets are, and we all understand it's supported by liquidity more than anything else. So I think everyone has to take a view. As a long-term sovereign wealth fund, which is an index benchmarked, we can take a slightly more long-term view about this and really not have to have everything in the market at this point in time. We do believe, however, that it's increasingly becoming a market where the strong will get stronger. And essentially, when you look at how market behavior is changing and consumer behavior is changing, quite clearly, I think especially, the bigger tech companies will continue to dominate and actually extend the dominance. You, of course, then run into regulatory risks. No government likes having dominant companies in any market. But certainly, I think, at least from an economic corporate point of view, certainly that seems to be the direction where corporates are behaving. As a sovereign wealth fund, of course, we try to make sure basically that we're well diversified. But that means, of course, as well that, in areas which are strategic to Malaysia, so for instance, in tourism, such a big industry in Malaysia, where we have exposure that's taken a massive beating over the course of the COVID crisis. But, again, like I said, as a long-term sovereign wealth fund, right, you turn your strategy towards essentially preservation of capital and preservation of cash flow, forget about growth for the next 3 years, right, and just make sure basically that your assets survive, right. And in that respect, I think in downbeaten industries and sectors, it's going to be very clear that those assets which have the backing of capital will have the opportunity to ride through the storm and probably have the opportunity to acquire more assets at probably very decent prices during this crisis. So, as an asset owner, I think, we continue to believe that it pays to have your eyes focused on the long term. I think everybody recognizes the fact that your results this year are going to look pretty terrible due to all the volatility and overexposure to certain difficult sectors. But as long as you believe in a 10 to 20-year plan, I think essentially that we should stick to that strategy and hold up for it. So I'll end there for the moment, let my other panelists chip in, and we'll get back to questions after that.
Thank you very much. An honest and open view about the challenges. We'll now move to Thailand and Shrikana. Thank you very much. I think you're just on mute at the moment. There we go.
Hello, can you hear me?
Thank you.
Okay,
yeah,
good. Yeah, okay, thank you. I'm Srikanya from Government Pension Fund of Thailand. We manage about $23 billion fund for about 1.2 million members government. I like to say that most of the things that Sharif have said, I kind of agree with him. So I'd like to add some few points, which is a little bit different from what from his viewpoint. In GPF, what we consider the pandemic is considered it's like it's a black swan event. We think it is an outliner, it's carrying an extreme impact, and we can explain and predict it. And we think that even we are in the midst of the current pandemic crisis, I'm pretty sure that the pandemic will normalize. It's not this year, it's going to be next year. So we see the pandemic as a come and go event. Yes, it creates some impact to our portfolio, and as some countries locked down, and also the economic locked down as well. Our response to the pandemic is of two nature, the short term and the long term. Regarding the short term, we did some tactical, our portfolio, but only temporary. All of our short term responses are to reduce the portfolio risk. We also look across portfolio for area that needs immediate action. Of course, reduce our portfolio to sectors that are hit hard and have unclear future, whether they will be back to normal once the pandemic is gone. We also increase our exposure to sectors that can adjust to the lockdown and gain competitive advantage over competitors. For the long term, we think we need to do serious thinking about our long-term strategic asset allocation. We know that the pandemic is bringing the new, we call it the next normal. That means once the pandemic is gone, not so many things will go back to their original normal before the pandemic. And regarding the new investment area that GPF is considering, we are considering responsible investment to integrate the ESG factor into the investment process and also the human rights. Another area which will be interesting for us is the factor investing, extracting the factor out of all assets and invest based on those factors instead of traditional assets. I think that would be all for me.
Thank you very much for that. We'll now turn to the view from Korea from Dong Hun, please. Thank you.
Yeah, thank you for having me here, Mark. Today I will express, my opinion about the role of long-term capital in a post-COVID recovery in case of POBA's cases. POBA with the $12 billion AUM is sitting on more than 10% cash, but in such a unique challenge due to the COVID, we are having trouble deploying capital in private market as a long-term asset owner. The Korean pension fund for regional public servant adopt a very risk-averse investment strategy. POBA is similar to U.S. college endowment in its absolute return-seeking philosophy. We enjoy a consistent cash inflow thanks to the job security of our members. The fund has a relatively low exposure to public equities, 14% at the end of last year, and 55% in alternatives, including hedge fund, equity, private debt, real estate, and infrastructure. It has over 10% in fixed income securities and a high percentage in cash, over 10% at the end of last year, which has increased since the beginning of 2019. As interest rates come down, our members tend to contribute more, so we had a strong cash inflow from our members. Also, we have been prepared for the late stages of the market cycle. We are also conscious of the fund's high allocation to less liquid asset. So we were reserving cash in case of liquidity call. With excess cash available, we are looking into the market opportunities to see if we can find opportunities. However, our counterparties such as GPs are in freeze. The biggest obstacle is deploying our capital. With our funding ratio of 101.4% at the end of last year, our mission is to maintain it above 100% level. This is the first time above 100% since 1992. Though a COVID situation is challenging, we tried to utilize it to improve our funding ratio and also contribute our long-term capital to stabilize the current unstable capital market. Under the unique challenging market environment, we are always care about 300,000 members and their families. Our fund is for their retirement. With a longer-term time horizon in mind, we could move more rationally and intelligently with a strong conviction. Our target return is 5% with the mantra focused on not losing money. Since 2015, I have overseen the portfolio, and that has coincided with the reduction in listed equities from 30% to 14%. Now we are gradually rebalancing back to 14% using the market dislocation. In alternative asset, we have put money to work in listed alternatives, including REITs and the listed infrastructure fund to overcome the frozen private market situation. We are using the so-called convergence strategy of investing in listed and unlisted assets. We can invest in real estate, in bond and the stock market using mortgage-backed securities and listed REITs. Regarding REITs, their share price have dropped in line with the listed stocks fall. If we pick them selectively, we can find a good investment opportunity. We have also considered some dislocation in credit and distressed debt areas such as CMBS and RMBS. Across the alternative portfolio, we have increased investment in debt tranches, including real estate and infrastructure and private debt. We have contributed our long-term capital to the areas in which each asset class was really in need of our capital to be normalized. As we increase our private market investment, we have started to realize that technology transfer and knowledge sharing are important drivers for investment. The COVID situation has accelerated the technology advancement already on the way. We have increased our investment in industrial logistics in real estate during the past 10 years, which accelerates the e-commerce development. In our REIT and listed infra investment, data center and cell tower portfolio are included. For more sophisticated private market investment, we need more collaboration from able GPs and like-minded asset owners. We think COVID reminds long-term capital to more focus on ESG investment from longer-term perspective. We cannot exactly know how the COVID recovery will play out. However, as a long-term investor, this kind of dislocation is a good investment opportunity to realize how the long-term capital could contribute to the whole society, as well as our beneficiaries, as long as we can maintain our long-term perspective. Thank you.
Thank you very much, Dong Han, and it's fantastic to hear such a breadth of comments. I know that we're going to come back to this again shortly. I'm already seeing some questions coming through. So I'll now hand over to Leanne, who'll give us an Australian perspective from one of Australia's most successful and largest pension or superannuation plans. Thanks, Leanne.
Thank you, Mark, and also thank you, for the opportunity to be here, and good afternoon to everyone. It's a pleasure to be here with the other panelists and also to listen to what they're doing and their perspectives as well, because we're all very diverse backgrounds. As Mark's mentioned, Cbus Super, we're an Australian industry super fund. We have around 55 billion Aussie dollars under management. Our member base is predominantly drawn from the construction, building and allied industries, so very much immersed in in the rebuilding phase post-COVID. In terms of our asset allocation, we can invest, and we do invest in both listed and unlisted markets. Our default portfolio option, and this always surprises international investors, our default option has around 70% of our assets in growth assets, of which about 50% of that is listed equities across Australian emerging market and international equities. So quite different. Often it's quite different to how other funds invest. In terms of our unlisted assets, we have around or just under 25% invested in property and infrastructure. So that's just trying to give you a bit of a flavour about how we invest our assets. You might think, given that and given what markets have done, it's been a very challenging time, and it absolutely has been a very challenging time for us. But I'm pleased to say over the past financial year so ending June 30, we actually finished in a very small positive. So quite an exceptional outcome in a fairly challenging time as well. So that's just trying to give you a bit of a flavour from our perspective, from an Australian investor's perspective. In terms of COVID, and as it's been said many times, I think probably the most popular word is unprecedented, be it whether we're talking about the health crisis or whether we're talking about policy response. It's very much been an X factor, and I wouldn't think anyone had it in their central view, nor perhaps even in any scenario that they may have run when they're trying to stress test their portfolio. And it certainly wouldn't have been a high probability if it was in one of your scenarios. What it's caused, though, as we all know, is a very severe and abrupt halt in growth induced by the containment measures that we've seen. What it's caused, though, is massive dislocations in labour markets, in industry structures, in confidence, and importantly, in private business investment and private business investment intentions. In response to all of that, we've seen, though, as I said, unprecedented policy response, be it from a monetary perspective or from a fiscal perspective. The magnitude of monetary response, so for some countries, has been limited by their starting points, because some went into it with already fairly low interest rates, and central banks' balance sheets, whether they've got a reluctance or otherwise to do it. Other central banks, though, have been doing as much as they can, but arguably limits are starting to be reached on the monetary policy side of things. And as we know, fiscal policy needs to be taking a lot of that baton, and as we know, it is in many countries. To give you a bit of a flavour, and Senator Hume spoke about this in terms of what we've been doing, the direct fiscal impulse in Australia is around 8.6% of GDP, so it's hugely significant, and in a number of countries it's double what we saw through the GFC. I think it's important to note when we look at that fiscal policy response, in the first instance, it's been very much about trying to maintain the economic structure and support cash flows, be it in households or businesses. I think we're now at the point, though, where policy, as we're moving through that inflection point, and Agnes spoke about this, we're starting to see signs of recovery, but it is very much going to be a journey here in terms of that recovery. Fiscal policy now needs to pivot to be focusing on supporting innovation and productive capacity and building in investment. In terms of and it also very much needs to be focusing on job skills and labour market creation. In terms of our role as an asset owner, I should mention, and Senator Hume spoke about this, in our role in supporting that cash flow, we were part of the system where we supported the early release of superannuation up to $20,000 over 2 tranches. So the superannuation sector played a role in that first phase of supporting cash flows. But from now, we have to look at what's our role going forward. And the superannuation industry and asset owner industry absolutely has a very strong role as long-term investors to support that and to support that building the bridge. In terms of our role and CBUS Super's role and other industry funds within the Australian marketplace, we're working collaboratively with the government to help fund some of these projects and also build some of these projects. In terms of examples that we've been involved in, we've supported and invested in the National Housing Finance and Investment Corp bond issuance, and that helps fund projects in community housing. So it's a fairly small example, but it's an example of what we're doing. We're participating also in capital raisings, be it in debt markets and also in the equity markets. Longer term, though, we'll continue to play that role in helping build that bridge to the other side. Just to guess a couple of other key messages I wanted to leave you with in terms of how we see things from our perspective is, I think the asset owner community absolutely has a role here to help build that bridge to the other side and help the economies gradually climb out of this. There is going to be significant sector shifts and sector transformations, and we need to play a role in that. But also we need to be mindful that to meet our fiduciary obligations to members. So we're playing a role, but as long as we're achieving very strong returns and continual returns to our members. In terms of the other aspect we think about is where on the capital structure we want to participate, whether it's in the debt market, in capital raisings, or in direct investment. And I think Agnes raised this point in terms of the importance of the role also of the small and medium enterprise sector, and in the private markets aspect, that's a very critical factor, because a key here is what goes on in the labour markets, and they're very significant employers of labour on that side of things. The other thing I think the key message to come out of this in the post-COVID world is we're seeing an acceleration in trends that were already underway. I think one of the key themes that's come out of the discussions today is the focus on ESG and ESG integration. And the other area that we're very much focusing on within CBUS is how we think about climate change and climate change scenario analysis, both from a top-down perspective, but also at an asset class perspective. And I think COVID has really accelerated that, that aspect, and we need to be very mindful of that. The other aspect, the other theme I wanted to leave you with is, and it's been touched on before, is we do expect that the interest rate environment is lower for even longer. Last year we were talking about lower for longer. We're now talking about lower for even longer. And we've seen the US Fed, and in Australia we've seen the Reserve Bank here, effectively saying that interest rates are going to remain where they are at unprecedented levels until they actually see inflation pick up. Typically, central banks will move in anticipation of inflation, but now they're actually going to wait to see it. An example of the low interest rate environment that we're in, and Agnes might have a different view in terms of, because bonds are already very negligible in Europe, but yesterday the Australian government here to help fund their debt issued for the first time a 30-year bond at 1.9%. They raised $15 billion and it was more than double oversubscribed. So there's absolute appetite for long-term quality, but very low interest rate products. So I thought that was quite exceptional, but it's just to that thematic that interest rates are even lower for longer, but it raises very significant discussion around how do we value growth assets and what does it mean for equity markets? Are we just pushing the problem further down the road in terms of asset price inflation that's currently going on? We could have a whole discussion about the intergenerational issue there. And then the final thing I wanted to leave you with, and what it's really highlighted to us at CBUS, is the importance of total portfolio thinking. We often think about portfolios from an asset class perspective, but we very much need to bring our total portfolio thinking together. So not just looking at a portfolio from an expected return lens, but very much looking at it from a risk perspective, a liquidity perspective, and also a thematic perspective. So that's a really important. It's made it very explicit in our thinking about how we look at portfolio construction and not just look at it from an asset class perspective, but very much from that total portfolio thinking. So I'll leave it there, Mark. There's a lot we could talk about, but appreciate the opportunity to make a few comments.
Thanks very much, Leanne. For the next stage, we do want questions from the audience. I have a couple here, but I'd encourage you to type them in, and we will ask them to the panel. And we have such a broad range of views and perspectives. I really do encourage you to ask some questions. But to help me in that process, we have Didier Borowski, who's the head of global views at Amundi. And Didier, I've asked you for the very difficult task to perhaps summarize what you're hearing across our 4 asset owners, but also overlay your own view. And then perhaps you could ask the panel the first question if you have one. So I'll hand over to you, Didier.
Yes, thank you. Thank you. It's a pleasure to be with you this afternoon. Panelists have said many things already, but I'd like to wrap up some key messages that we have. First of all, we are evolving in a new macro-financial landscape, and it's not only related to the COVID-19 crisis. I think it's a key point that I'd like to make in introduction. My point is that the real equilibrium interest rates had started to decline well before this crisis, and even well before the great financial crisis. And it has been a new, I would say, a new macro-financial environment for a long time. The second point that I'd like to make is that the great deleveraging has not occurred. It has not occurred following the great financial crisis. And what we are seeing these days is a great re-leveraging of the global economy, both regarding private debt and public debt. And that's something that is a new, I would say, phenomenon that has immense consequences in terms of economic policies. I think we all understand that it's an atypical shock, an unprecedented shock, and we have moved in terms of economic policies in uncharted territory. My point is that there is no more, border between monetary and fiscal policy, and to some extent, central banks are now trapped in their QE policies. I think the point was very clear. Bond yields are low for even longer than before, and the reason why. And Lynn Taylor was very clear on that, but the reason why, at the end of the day, bond yields will be low for longer is that central banks are trapped in their QE policies because the level of debt has increased to an all-time high, both private and public debt. What does it mean? It means that the only way to maintain public debt sustainability and debt sustainability is to maintain low bond yield for a long period of time. So it will be true as long as we have no inflation. I will come back to that point, but I think that fiscal dominance and debt monetization are here for a long period of time. So I think Agnès was very clear also on the fact that this is a sluggish recovery. Yes, there is a recovery, but this is a sluggish recovery and probably more sluggish than many investors believe. So we are enormously concerned by the fact that what is discounted in equity markets is a kind of V-shaped recovery for next year, while we have, well, let's say, I don't know how, with the alphabet, it's always very complex, but it's a much more sluggish recovery when we look at GDP that we do expect. So it means that markets should not be as directional as they were over the past few weeks, over the past few weeks and months. The fact that we have a slow recovery, that uncertainty is here to stay, because uncertainty is related to the dynamic of the pandemic, which is not under control, to geopolitical factors, and it was mentioned, that are here to stay. I mean, the relationship between China and the United States, we all understand that they will stay deteriorated for a long period of time. It's a Cold War in the making that will have consequences. We all understand that the US elections may also, have very large consequences in terms of fiscal policy in the United States. So what we are seeing in these days is a kind of a new environment that is likely to stay very uncertain, and the fear of depression will continue to encourage the authorities, both central banks and government, to maintain a very expansionist policy mix in the foreseeable future. Because the big risk is a kind of debt deflation spiral if they abandon this point. So what are the consequences for investors? So that's first point. That's true that we are seeing some disinflation following this crisis, and that's mechanical. I would say when you face such a shock on global demand, you have disinflationary consequences. Having said that, we do believe that market inflation expectations are excessively low and far lower than what household surveys tend to indicate. So at some point, there might be a moment of truth, not in the coming 18 months, but I would say in the coming years. I think it would be wrong for investors to consider that inflation will stay as low as it is today for an extended period of time. So meaning that it may generate quite some volatility in the future. And investors should protect themselves toward this. So at some point, what we would expect is a kind of moment of truth, because QE policies will continue as long as there is no inflation. So as I mentioned, no threat for the foreseeable future. But if we think about the coming decade, at some point we see the cocktail of deglobalization plus new social demands following this COVID-19 crisis, plus this huge accommodation both on the fiscal and the monetary side, as a cocktail that may at some point in time in the future prove more inflationary than what is priced in markets today. That's my point. Even if we understand the disinflationary consequences of technology, etc. So I think market inflation expectations are excessively low. And you will see more social demand for a kind of a rebalancing toward wages in this environment, because in fact, at the end of the day, the paradox of the situation is that QE policies, as we know, tend to reinforce the existing inequalities. And it has become a key thematic, I would say, to monitor at a global level. So what are the implications for investors? So as it was said by Taylor, well, we have to think about liquidity, portfolio construction in this environment. And we see that liquidity has become a critical dimension of portfolio construction. We do believe that, in fact, and it's not only a trade-off between liquidity and return, for sure, there is a trade-off between liquidity and return, but at the end of the day, we do believe that liquidity is necessary in this environment. It's to maintain a kind of liquidity buffer in this environment. And it's not only a defensive tool in our portfolios, it's also a key element to take some opportunities, and it was very clearly said by Dongkung Zhang, and that in fact the level of liquidity and of cash in portfolios gives some opportunities at some point to deploy the asset allocation toward new risks. So just to sum up, and I think after it will introduce the discussion, but we do believe that in the coming 10 years, we'll see lower returns on portfolios, but it does not mean that you don't have investment opportunities. You have new income engines, and it was very well said, real assets, dividends, and the ESG will also be an increasing feature of our portfolios. We like what we call idiosyncratic alpha. We believe that there are market inefficiencies that even if markets are not directional, that may benefit in this environment. And finally, and we'll conclude with that, we have as a deglobalization thematic is probably a thematic that will at some point offer unique opportunities to diversify portfolios differently and to enhance, in fact, the risk-adjusted return in portfolios. So to conclude, just if I have a question, I have a question for my colleagues in Asia. I'd like to know, in fact, in this environment where risks are quite elevated, where markets have been very directional, how do they do to hedge the extreme risks in their portfolios? What kind of tools they use for macro hedging, and in particular regarding the relationship between US and China? We understand that an escalation may come at some point. So I'm curious about that.
Thanks for the question, Didier. And we've begun to get a number of questions through here, and exactly along the same lines. I'll read this one out. It says, after such a large shock to the global economy and society, does this warrant your fund to review its long-term strategic allocation, or is it a cyclical event? And I think you're also asking, Didier, about the management of risk in the same context of asset allocation. What I'll do is I'll direct these questions, if I could, so that everyone can have an input. Could I ask maybe John Hun to just talk about his asset allocation? Because as you mentioned, you took a brave call to allocate away from listed equities into a broader portfolio. Could you answer that question in the context of the current market? Is it changing your asset allocation? And then perhaps I'll ask Shireel for a comment in terms of his positioning.
Well, as I mentioned in my speech, I think our portfolio is quite unique because, as I said, we seek on annual basis, we seek absolute return strategies. So that's why we have a quite high percentage of alternative investment. So yeah. So under this kind of market environment, our strategic asset allocation perspective is quite challenging, because if we really focus on marketable securities such as a traditional portfolio, such as fixed income securities or public equities, we may mobilize our portfolio as much we would like to have. However, in this kind of COVID situation, the private market environment is quite in freeze. I mean, they cannot make our transaction or investment or due diligence, whatever they would like to have. So that's the challenges we have.
And just as Didier mentioned, is the nature of what's changing in the markets, is it changing your ability to find diversifying assets? Are you worried about the lack of diversification that the markets may behave in the future?
Can you clarify, Judge, one more time? I'm sorry.
So with the nature of the markets and so much capital and very low interest rates, are you worried that your portfolio will not act in a properly diversified way in the future, given all the changes that we're seeing in the markets?
Yes. Yeah. I think our portfolios are quite diversified. However, as I said, that the reason being we invest heavily in alternative investment is just because fixed income securities provide very minimal, very lower return or even negative return. So that's why we have quite heavily exposed to that environment. So maybe in the future, as Delia mentioned, if this kind of abnormally lower environment continues, persisted in the future for those extended period, then maybe our portfolios may have to more focus on alternative investment by diversifying into very different kind of asset class.
And Shireel, has your asset allocation changed, or your thinking around asset allocation changing?
Our thinking around the long-term asset allocation hasn't changed that much, to be honest. Where we are seeing differences or opportunities, probably better way to put it, essentially, is trying to take advantage of dislocations on pricing and liquidity in certain asset classes at certain times, right? But over the long term, I think if you think of using prices and risk management basically as a tool to balance your portfolio, that essentially over the long term, I think you start to approach whatever long-term strategy you decided is actually appropriate for your own fund's objectives. So for us, for instance, I think at least as far as our commercial opportunities are concerned, which is really about long-term intergenerational wealth management for the country, it's still very much focused really on finding the right mix of assets and risks that gives you a sustainable inflation-adjusted return for the funds that we have. Coupled with the fact that as a sovereign wealth fund, the main goal really is to diversify the nation's income away from domestic sources. So we will continue to essentially put out money into global asset classes to essentially diversify that income base. So again, like I said, I think it'll be very careful how I phrase this. It's really dependent, I think, on each fund's goals and objectives, right? So I don't think it's going to have a one-size-fits-all solution to what we're facing today. So for some of us, I think some of the dislocations that we're seeing is a godsend in terms of being able to enter into risk premia or enter into basic assets that we feel we need for our long-term goals. And for some, of course, you're exposed to areas where, unfortunately, right, you're already overly exposed anyway.
And Mark, can I just maybe add a couple of comments, just in terms of, I guess, whether COVID has impacted longer term asset allocations? I guess a couple of key things that we're thinking about and looking at, and Didi sort of touched on this before, the starting points for your valuations are higher than what you would normally have at this point in time. So whether that's impacting your longer term expected returns, or whether investors start adjusting the probability of achieving their investment objectives. So that's one aspect. A key issue for us that we're really trying to explore and don't necessarily have the answers at this stage is, how do we think about defensiveness in our portfolios, particularly for what I would refer to as our more conservative options, which have traditionally had a very high exposure to fixed income assets. So that's a key thing that we're exploring in terms of what allocation do we want to those types of assets, but then what do we substitute in for them? So sort of really thinking about the defensiveness of the portfolios is a key thing for us.
Yeah, thanks very much, Leanne. So the central banks have taken away the defensiveness, or the market has, or however you want to view that. We have a number of questions about the environment, about climate, but I'll just read this one out, perhaps for yourself, Agnes, if I could, if you're happy to answer this. What is your view of the EU Green Deal? And post-crisis, could it be a blueprint for private and public investors to build back better, is the quote here, and align sustainable growth with impact? We've also had a number of questions about environmental issues, climate change. So perhaps if you could give your perspective, Agnes, and the way Barings are viewing this whole development.
Yeah, thanks, Mark. This is a question for the future. It's very relevant for sure. I think the approach in Europe, is remarkable in two different ways. The first one is that governments have finally decided to take a coordinated approach to this type of investments. These are, the green transition is considered to be a public good that benefits all the populations together. And because there are externalities to the investment, it is considered, useful that a central planner, in a way, determines what are the needed investments so that there are no, inefficiencies in the system. And part of the new package, the European Recovery Plan that has been announced, includes probably 30% of all the investment that has to be green, under some sense. And of course, here the importance is to determine the right criteria and accountability. But there is a need to actually report once a year on how the investment is green, which I think matters a lot. The details are very important in that sense. And the second thing I want to say about this, this green investment is the transition. And the approach there, is, first of all, they have set up a just transition fund. And by just transition, they mean that these reforms towards more renewable energies and cleaner investment in general comes at a cost for existing industries, in particular old Europe, although they're moving fast. But there is a need, if you don't want to destroy the economy in the process, to offset some of the losses and support the transition and the labor that will have been displaced by this, by the favoring of different types of investment. And I think that's quite important. So these really are the two characteristics in the little time I have to describe it of the green transition plan. I think I would say at Barings, we've been doing green investment and impact investment for a long time. The equity team has been integrating ESG consideration in the portfolio since, a long years. It's one of many years. It's been one of the leading team in the approach, and they've been struggling, with what are the ESG value you want to defend. What do we really think is sustainable for the longer run? And we're soon going to publish a paper on this approach. And the second thing is that impact investment has this advantage that it is accountable for its impact. It targets a particular impact and then along the way sets targets to achieve it and then reports on how well they are achieved. And then ideally, they reward investors for success. I think this approach is probably more and more likely to be adopted to become, just because it's just more credible. And we have a team, in particular, infrastructure debt team, that in its infrastructure investment includes some of this type of incentive designs. That's what I will say at this stage. Thank you.
That's great. We might just work our way across the panel on this topic, because we have 4 or 5 questions on climate change, environmental, and positioning of portfolios. I was asked recently by an audience whether these issues would survive the current crisis. If anything, it seems to me it's even highlighting the move towards investing in these areas. But I'd like to hear perhaps the asset owners and Didier's view on this. Hong, could you perhaps, Don, could you perhaps give us your perspective in terms of how it's affecting your portfolio?
That was clearly said by Agnes, and I fully agree that it's a new dimension to take into account. I would say, to put it in a nutshell, that Europe is a place to be, because at the end of the day, we have this enormous, I would say, fiscal package that targets also with a great focus on the green side. And in addition to that, I think there is an increasing social demand, not only in advanced economies, but also in emerging economies, for green products. We see that with the rise in green bonds. We see that with the fact that the appetite for ESG products has increased in this crisis. So my point is that clearly there is a game changer, and all investors that are looking at their portfolio construction understand that the COVID-19 crisis is a game changer that will, I would say, reinforce the ESG thematic and green investment. And when you compare among advanced economies, the United States and Europe, I would say that clearly Europe is in advance. And in addition to that, I just want to mention something, is that Europe was perceived until this crisis as an area which was quite dangerous, with a kind of political risk premium associated with the fact that at some point foreign investors, I mean outside Europe, were looking at Europe as if it was an economic region which would not be resilient to an external shock. And what we're seeing these days is that there is a very strong commitment from policymakers to maintain, in fact, the European Union and to and even the Eurozone. And my point is that clearly, and for the euro, for instance, the recent appreciation of the euro might be related to the fact that many investors tend to see now the euro as an international reserve currency, and it will probably gain ground over time. So what I'm saying is that we are not that quite bullish, I mean, in terms of investment, but what we are saying is that when it comes to green products, there is clearly a relative advantage for Europe. And that's objective. I mean, when you look really at, and in Amundi, we have been developing, in fact, ESG products for a long period of time. We have a wonderful team, and I can tell you that what we are seeing on a daily basis is an increasing demand worldwide for our ESG products that tend to confirm what I'm saying, is that this shock is perceived as a game changer and as an opportunity to increase allocation in these products, and in particular with a European focus.
Thank you very much, Didier. Don Hung, how are you approaching the issues of green? And I've received another question now about social development goals, particularly here in Asia, investing in the region. Perhaps you might want to touch on how your portfolio is responding to this.
Okay. To be honest, I think Korean society have started to focus on the ESG issues during the past, I think, more than 10 years now. But actually, their real action has not been made significant. But I think this kind of COVID situation has accelerated. The ESG investment is not just optional things. It is mandatory. That they have started to realize that it is mandatory. And also recently, Korean government, as you may be aware, I think Korean government have I think they did a pretty good job compared with other nations to combat with the COVID situation, I think. So after they did such a good job, and then they have announced a Green New Deal investment plan to activate to accelerate private so-called PPP type investment in that new area, such as I said, data center or new green energy, or and the cell tower, or various kind of new technology related investment. So they announced that they will promote to accelerate investment around 80 in US dollar, around 80 billion US dollar amount will be mobilized using private capital and public capital altogether. So I think this COVID situation has created such a big challenges. However, each country will I think react differently. So afterwards, I think the technology gap and well, maybe ESG investment level will be much different compared with the pre-COVID area.
Thank you very much. This discussion is sparking another range of questions, but all along somewhat similar lines. I've just received a question about natural capital and the biodiversity loss that's going on. So we're racking up problems which I think we all recognize. Sharil, how are you approaching this in Malaysia, and how does it get into the philosophy of your investing?
Yeah, so for us, I think we've been subscribers to the SDGs and the principles for a while now, and certainly I think it's fairly easy to do at the investor level. I think it's actually much more important for us to engage with the companies that we invest in, especially those in the Asian region and in Malaysia, who are probably on a very different journey in terms of actually addressing these issues for historical reasons and also for economic reasons. So I think as an investor, it's fairly straightforward for us to put in the right filters when we look at our own investments. But we're doing a lot of work now actually engaging with companies that are under our stable to talk about basically a lot of these issues, and particularly around the environment. And it's a difficult and painful transition. So for instance, Tenaga Nasional, which is the energy company from Malaysia, basically needs to transition away from coal. But that's a long and expensive process, right? As you think about replacing those coal plants with basically either natural gas or RE or other things that we can do. But more importantly, I think is to actually engage with them and make sure that that journey starts and that investment begins. So we're doing a lot of that stuff now. For instance, in our aviation sector in Malaysia, having those difficult discussions with the airport authorities and with the airline groups, right, to think about basically their carbon footprint and essentially thinking along the lines of what they can do to manage that. So there's a tension, obviously, in developing countries in particular right now, as we think about how we accelerate development and catching up on our national incomes versus, I think, some of these imperatives, which honestly, I think in a lot of developing countries are seen really as a first world problem that the first world is trying to foist onto developing countries which are still struggling with income issues. So it's a tension which I think is quite obvious and which I think a lot of dialogues required between the investor community and the corporates, especially in Asia, who struggle with these issues.
Thanks very much. It's a very, very good point. And I'd like to ask Leanne, but we don't have time. We only have a couple of minutes left, and we have been asked a question which is a common one, which is, are you bearish, essentially? Do you think there's another market correction in the near term? Now, I know as long-term investors, we very often just walk back from this and say we're long-term and we like to look through it. And so I appreciate the question's perhaps not a fair one because we are looking for long-term investing. That said, the theme that came out, I think, in some of the comments was that people were preparing for late cycle, were raising capital, being a little cautious in the last couple of years. So there was a sense, now we've had a COVID situation and markets have bounced back aggressively. Perhaps just in summary, I might just quickly go across the panel. If you give me a sense for the way you see the risks environment, whether you perhaps got a higher risk perspective, prepared to buy risk now, prepared to be cautious on risk. Just a quick summary if we could. Who'd like to go first? Or who would like to avoid the question?
Yeah, I think we'd all like to avoid it. I can make a quick comment about how we're positioned. So we do have a long-term asset allocation, and then we position the portfolio around that. At the moment, we are slightly underweight what I refer to as risk. The challenge for us, though, is the role that liquidity is playing in the markets and the fact that the markets continue to be supported by the liquidity. So we've actually implemented some protection across the portfolio to try and participate in the upside if it was to occur, but also to protect us on the downside. We can also use currency as an element of a risk protection as well in terms of how we manage the portfolio. I think a key issue for us is if we look at our longer term expected returns, is our starting points are higher and valuations are fairly stretched in a traditional sense, but that raises the topic of what's fair value in this environment, which could be a whole other session. So in a nutshell, we're slightly underweight risk, not overly underweight risk. Very mindful though, and we are fortunate to be able to be fairly nimble in how we can reposition the portfolio, but we do have some protection across the portfolio, given the liquidity, the potential for a liquidity boost.
Perhaps Dong Hoon, how are you seeing it?
Yeah, I would say that I think we have reduced our risk asset to some extent. So I think we are underweight that risk asset, especially in the public equity spaces. But I think under this kind of negative real interest rate world, I think individual investors or institutional investors, they were all chasing for returns for the time being. So I would expect that there are some a higher probability that the market bubble will be created for the time being. So I think we need to be more mindful of that issues. But I think for the time being, central bank will be more, I think reluctant to be more aggressively moving into that, market movement. So I think that where market will have higher probability will enjoy some, the upward movement, but there will be some, hiccups for the time being. So we need to be very careful.
I really am going over time, but maybe just briefly, Sharil, how are you seeing it?
Yeah, I think we're a bit risk off at the moment. Let's be honest. I think when you look at valuations today, I think we all recognize the fact that valuations across a whole bunch of stuff is 1 to 2 standard deviations away from long-term averages. I guess the key question to ask for funds essentially is, do you feel the need to participate, right? Do you feel the need to essentially show returns in this market? And I think for the real long-term funds and some of our funds who can afford to maybe take some risk off the table and wait it out, a lot of us are thinking about that at this point. And like I said, we are cashed up, mostly because we sold a lot of stuff at the start of the year and missed the bottom, like I've said earlier. So you're now in a quandary, right? You're holding cash. You've done pretty well to catch the first quarter, and now you're not sure whether you're going to go back in again.
Okay, I might just have to leave it there and thank everybody for their comments. I had meant to say at the start of our discussion that it's one thing to talk about finances and portfolios, but we also know that the one thing that's been collective here, this is a humanity issue. We're seeing a spike in cases here in Melbourne at the moment. We know that's affecting particularly the elderly, and so we give our thoughts to everybody that's on this call because it's affecting all of us collectively. And so I hope that everybody's safe and well, and particularly your families, friends, and colleagues. I'd now like to just hand over to Hani Kablowi. Sorry, I mispronounced your name, but you're the head of international and chairman of Europe, Middle East, and Africa for BNY Mellon. And just to really wrap up our proceedings today, but just finally, I'd like to thank the panel though for your input. I think it's absolutely fantastic the way our asset owners around the world are prepared to be transparent, both about what's going well and what's not, and how you're positioning and how you're thinking. It really does help the collective thinking of all of us as investors. And we know we have policy people listening into these calls, and I think they need to hear from asset owners as well, because you're out there juggling with the consequences of what is now a very policy-driven world. So I'll hand over to Hani. Thank you very much to the panel.
Thank you, Mark.
Goodbye.
Mark, thank you very much, and thank you to the panel as well. I have 1 minute to do this, so I'm going to try to stick to that time. Thank you very much to OMFIF for putting together the 7th annual GPI report. I think it's essential reading, not just for public investors, but also for anybody interested in global markets and the investment industry. I agree with Frank earlier. Frank mentioned that the issuance of the Euro sovereign debt is a watershed moment in financial and investment history, I believe. We have COVID to thank for accelerating the bringing about of that issuance. I think that it will provide a credible alternative to the dollar as a reserve currency and investment destination. 3 more things that I think will be accelerated by COVID or have been accelerated by COVID. One is the focus on resiliency and continuity. Everybody, all risk managers have been thinking about their resiliency and the recovery of things like data centers, what happens if a location goes out. But I think the imagination of our risk managers has broadened, and we're all asking ourselves what happens if 20% of our global workforce is not available to work for a period of upwards of 15 days, 30 days. So questions around resiliency and continuity will become a lot more thoughtful given the type of pandemic that we've just lived through. I think automation, digitization, and the use of data to drive investment outcomes, risk management outcomes, and operational oversight outcomes will accelerate. We've seen thousands of workflows get automated over the past few months, and I think thousands more will be automated across the industry. And then finally, a well-covered topic here is really the impact on investing in ESG. And I think two angles maybe not mentioned here that might be worth talking through or thinking about. One is the alignment of purpose, corporate purpose or institutional investment purpose, with the actions that people take. And secondly, the availability of tools and standardization in an industry that today probably is lacking it. I think I'm going to have to leave it there given the time. I do want to thank OMFIF again. We're very proud of our association with OMFIF, and I think the quality of this panel and of Danae's presentation earlier and of the report are testament to the quality of the thought and the people at OMFIF. So thank you very much for the opportunity.